Prospect theory and risk perception. Should you buy in a down market? The market's down, prices are dropping, interest rates are high, and your gut says, wait it out, this feels risky. But what if that fear is exactly what's holding you back from a smart long-term opportunity? Because in real estate and in life, how we feel about risk often matters more than the actual risk itself. Let's talk about prospect theory and how it's messing with your money. Hey, I'm Hemen, a real estate educator and someone who dives deep into the psychology behind smart and not so smart financial decisions. Today's video tackles a question so many people are struggling with right now. Should I buy in a down market? Prices are soft, news is negative, rates are still high. But here's the twist. The fear you feel today might be pushing you away from a smart decision, and it's not your fault. That fear comes from a powerful concept in behavioral economics called prospect theory, developed by Nobel Prize winning psychologist Daniel Kahneman and his research partner Amos Tversky. It explains why we fear losses more than we value gains and why our brain distorts risk when the stakes feel emotional. In this video, I'll break down how prospect theory explains buyer's paralysis in downturns, why people overestimate short-term risk and ignore long-term rewards, how to shift your mindset and act when others freeze. Let's dive in. 1. How prospect theory explains buyer's paralysis in downturns. Let's start with the core idea of prospect theory. We experience the pain of loss much more intensely than the pleasure of gain. Kahneman and Tversky showed that people will go to irrational lengths to avoid losses, even when that means missing out on much larger potential gains. For example, if considering buying a property in a market that's dipped 10%, your brain starts screaming, what if it drops another 5%? What if I lose money? What if I look stupid for buying now? The fear of losing $20,000 feels stronger than the hope of gaining $60,000 over the next 5 years. So you do nothing, and that decision, it feels rational, but it's based on emotion, not economics. This is loss aversion, a central piece of prospect theory. It doesn't mean you're weak, it means you're human. 2. Why we overestimate short-term risk and ignore long-term reward. In down markets, our perception of risk becomes distorted. Here's how. We focus on the immediate possibility of loss, not the long-term trajectory of growth. We get fixated on headlines, interest rates, and short-term volatility. We forget that wealth is built in years, not quarters. Think about this. In 2018, buyers in some Vancouver markets waited for prices to fall. By 2020, many of those same properties had surged beyond previous highs, while the waiters were still waiting. Why didn't they buy when it dipped? Because the pain of a potential $30,000 short-term drop felt worse than the possibility of a $150,000 long-term gain. Prospect theory traps us in the moment. It magnifies fear and minimizes future reward. 3. How to shift your mindset and act when others freeze. So what can you do to avoid this trap? It is a 3-step mental model that helps you apply prospect theory without being controlled by it. A. Zoom out. Redefine the loss. Instead of asking, what if I lose $20,000 in value over the next 6 months? Ask, what's the cost of waiting 5 years to buy this very same home at $100,000 more? Or what's the opportunity cost of renting for another 3 years with zero equity? These questions reframes your view from short-term pain to long-term cost, which is a more accurate picture of real estate investment. B. Flip the emotional script. Prospect theory shows us that people react more strongly to lose than gain. So use that bias to your advantage. Tell yourself, if I wait and miss this window, I'll regret it for years. If I don't invest now while others are scared, I might be buying at the peak later. Sometimes the fear of future regret is more powerful than the current hesitation. See? Use data to ground your emotion. Emotion exaggerates risk, but numbers bring clarity. Instead of guessing, run the math. What would monthly payments look like now versus if prices rise 10% later? What's the historical appreciation rate in your area over the last decade? What's your break-even point if you buy now versus wait? For example, you buy a condo for $650,000. It drops to $630,000 next year, but then rises to $720,000 over the next 5 years. In this scenario, you lost $20,000 on paper but gained $90,000 in the long-term value. Would you still say it was a bad move? Would you still say it was a bad move? Prospect theory explains why we freeze in the face of uncertainty, why we avoid smart risks, why we wait until prices rise again just to feel safe, even if it means paying more. But real estate rewards long-term, strategic thinkers, not emotional followers. So if you're asking, should I buy in a down market? The better question is, am I avoiding a loss that hasn't happened or missing a gain that's just beginning? If this video helped shift how you think about fear, risk, and opportunity, hit that like button. It helps push this to more people making big decisions. And if you want more content on behavioral economics, real estate psychology, and building smarter financial habits, make sure to subscribe. Comment below, have you ever missed an opportunity because the timing felt wrong? Let's talk about it together. I'm Hemen. Stay calm, stay long-term, and remember, your brain fears loss more than it sees growth, but growth is where the wealth is.